Hey guys, hope you are all having a great day. I purposely avoided making this video throughout the week because I wanted to avoid spreading panic and fear. I held out hope that the United States government, as faulty as it may be, would get its act right and reach a sound decision by the end of the week. And yet, unsurprisingly as it may be, it appears that the United States will default on their debt. I am going to keep things super simple for you guys, because this is a lot of a bigger deal than you might think. Many of you don't know what hitting the debt ceiling is, so let's start by laying out a proper foundation of understanding. The national debt limit is a cap, which is decided by lawmakers, which established how much debt the US government can have. As of this past Thursday, we finally reached that limit, which sits at $31.4 trillion. Whenever Congress passes a spending bill, they decide what the government will spend its revenue on. That revenue comes mostly from taxes. Most of the time, the government doesn't have enough revenue on hand to pay for everything in these spending bills, which often include infrastructure, Social Security, Medicare and defense. This has been the case since 2001. The gap between revenue and the things the government is spending money on is known as the national deficit. As of right now, we are spending more money, over $1 trillion this year, than we are actually taking in. That puts us on a deficit. To make up the deficit and pay off debts, the Treasury sells securities, in particular bonds. Bond buyers give the Treasury cash to pay the deficit, and in exchange the Treasury eventually pays the buyer back that money plus interest. The debt limit caps how much debt the Treasury can take on to pay back the deficit incurred in previous years, and as of Thursday, the Treasury has taken on the maximum amount of $31.4 trillion in debt currently allowed, which is why all the news outlet you are seeing have emboldened the tittle that the United States has hit the debt limit. The debt limit, as I mentioned earlier, is decided by the lawmakers in Congress. So, you might be thinking this is a crisis at the moment, but it isn't, not yet at least. What happens when we hit the debt limit can be explained best as thinking of it as the beginning of a final countdown. It means there is a time limit by which the government needs to hurry up before real disaster kicks in, which in this case would be defaulting on the debt. The United States needs to come together and into an agreement to either increase the amount of debt it can take on or suspend the limit to that debt before it runs out of money. Treasury Secretary Janet Yellen believes that money will run out by June 5th of this year. If the United States cannot pay the bills, then it defaults on the national debt, and that, my friends, is when you will quite literally be witness to chaos. You might be wondering, but why is defaulting so bad? You would believe the United States can quickly remedy to some type of solution if we reached the point of defaulting, but you would be wrong. If we did that, the Treasury would stop being able to pay out federal money, which goes to things like Social Security, Medicare benefits, military salaries, interest on the national debt, tax refunds, your local public school teachers, your police officers and firemen. Pretty much everyone that works for the government, and any agency that depends on the funding by the federal government, would stop receiving money effective immediate, and I don't think I would need to remind you, but nobody likes working for free. But it's even more than just salaries, it affects the security markets directly as well. It would mean the Treasury would not pay back the money and interest it owes to bondholders, which means absolute stock market panic to the point that you can confidently believe that there will be a stock market crash. If the United States government cannot pay its due, it will signal to the world full of investors that nothing is safe anymore. Obviously, the US credit rating would be downgraded and interest rates would broadly rise for many consumer loans, making products like auto loans and mortgage rates more expensive for everyone. In order to sell their debt, there would be a need to have to sell it at higher rates. The risk would be massive on these as well. So why have we hit the debt limit? Well, Congress missed the deadline set by Yellen after unreconcilable debates between congressmen began over spending. I am just laying out the information as it's factual, so what I am about to say next isn't a jab but rather an objective fact. Republican Party members are unwilling to agree to any increase in the debt ceiling unless there's an ironclad pledge to reduce spending. The problem in all of this is that, simply put, we are spending too much money, and everyone obviously agrees to this fact. But when you sit down and look at what you can cut, then it becomes trickier. It becomes a real strain on where you can cut costs, because if you cut Medicare, millions are affected. If you cut Social Security, millions are affected. Neither party wants to increase taxes either, and neither party also wants to cut defense spending either. So as you can see, any sort of discussion in goodwill to fix things sort of clogs in this part of the problem because everybody thinks differently about where it would be wise and hurt Americans less and where they cut. It is important to note that the United States has never defaulted on the national debt before, and the United States dollar has only ever been downgraded once. We are literally just on the first month of 2023, and though we are in a gridlock, a lot of things can happen between now and June, so it's not panic time at the moment, but the deadline is set. The United States government cannot just simply continue to be inefficient and sit on the curve, because it is on a time limit to come to an agreement before the Armageddon of all economic crises peaks its head. So, with this topic said and done, we need to talk about the current state of the economy, because right now it appears everyone is very 50-50 in terms of confidence on where things will go. Since 2023 started, markets have been performing remarkably well, at one point bouncing and testing the biggest downtrend line. It was rejected, but with Friday's market rally, many believe that the stock market is in perfect position to have a huge run-up. Once again, there are factors, influences and variables known and unbeknownst to me that are pressuring the markets to go up, and though I am not bullish about this current economy, in particular now more than ever, I will also not say it's impossible for markets to recover a bit from the non-stop dipping they have been doing for months. However, this does not mean you can expect a market rally like that which we saw in 2020 when the Fed went printing money non-stop. In fact, at the best scenario, I see markets shifting from a downtrend to a neutral sideways trend for a while. The markets are inherently forward-looking and optimistic long-term, and everyone is in a bit of a rush to catch the dip before the rip, but I am not as enthusiastically inclined to share such unchecked energy, because the data I am about to produce to you shows that the real players who are moving the pieces are not at all comfortable with what is to happen next. Let's begin with the most important determining factor in what happens with the markets and inflation, the Fed. Fed Reserve Governor Christopher Waller made a wild statement today, saying he favors a 0.25 percentage point interest rate increase at the next meeting, as he waits for more evidence that inflation is heading in the right direction. He then did state that it is not time to declare victory on inflation yet, comparing monetary policy to an airplane that soared higher quickly and now is ready for a gradual descent. This is the main reason why markets went on a huge rally today, because the governor gave signs that he is hawkish, though closely checking for confirmation that inflation is being decreased consistently. So why am I still bearish, or at the very least, skeptical about this suddenly bullish market that believes all the bad things have been priced in? Well, because I don't think the markets have actually priced in all the things that can go wrong. For as any bullish statements the governor might have said today, the Fed wants monetary policy to be restrictive and for financial conditions to be tight. Yeah, inflation rates are coming down, but labor market is still very hot, and based on the latest data, the economy is still growing at an above-trend pace. The Fed can slow down the rate hikes, but that doesn't mean they are done hiking it up. The Fed understands that a tight labor market can lead to wage inflation, which will lead to another inflation. Pay attention to what I am about to say next, because it will explain everything. If we put inflation data and news aside, we see the United States economy as being strong. Based on the latest economic models from the Atlanta Fed, they suggest a nominal growth rate of around 6%, which is a very healthy growth rate. Looking further, we see that financial conditions have eased back to levels last seen in 2022. This suggests that financial conditions are nowhere near restrictive levels and that they are accommodative and aid in supporting the economy. Furthermore, the boost we have seen in the markets is also partially due to China reopening trade, pushing prices higher on copper, gasoline, oil, iron ore and many other important commodities. The Bloomberg Commodity Index is on the rise and from a technical standpoint, looks strong and bullish at the moment. When we put inflation aside, we see a strong and recovering U.S. economy, which is what government officials are working 24/7 to have the corporate media brag about to quell fears and uncertainty from potential voters. However, there is a caveat, a but bigger than Kim Kardashian's in this whole picture-perfect viewpoint. This gorgeous picture of economic perseverance is not due to the actions done by the Fed. The Fed has said time and again that rates are going to go higher and higher for the time to come, and this is the fundamental problem with these rallies. The market believes that we touched the bottom and that because the economy is stronger with lower inflation reports, that the Fed will pivot. After all, the market is forward-looking, not present-looking. As such, everyone thinks all factors are priced in and everyone gets bullish and markets rally, making the Fed's job not only much harder, but forcing their hand to have to increase rates even further, which throws a rock down the machine's mouth and markets become unstable with news and a frenzy of sell-offs begins, sending us back down. This is a cycle in that the more investors want to rally, the longer they will make the pains of a bear market last. Furthermore, Remember that rate hikes take a while to begin to be felt. We haven't even begun to feel the pain and effects on the economy, which might themselves lead to a recession alone, and nobody wants to acknowledge this. We are seeing Google, Microsoft and Amazon fire tens of thousands of employees this month alone. Imagine what the rest of tech is going to be along with the financial sector in coming months. Another problem the Fed must face is that wages are still rapidly growing, which adds plenty of fuel for fears of further inflation. When I read about analysts being bullish and wanting to discredit a bearish thesis on the economy, they still seem to be obsessing over the consumer data and have been wrongly bullish since late 2021, which to me discredits them in my eyes, as it means they did not see nor admit at any point before or through this bear market that things are not right. Is there a chance that the Fed can achieve a soft landing? Yes, there is a chance. Is it likely? It's impossible to tell, but I am bearish for a reason. What is the worst case scenario for 2023? A huge market crash during summer due to the United States defaulting on their debt. What does the most bullish scenario look like? The best bullish scenario has a slightly growing but at a slow pace, which allows the Fed to adjust along with the economy to all the needed changes. We continue to see further evidence that inflation peaked, lower CPI reports among other key economic data. As of right now, the Fed is in control of everything. Even with good data, the Fed will be the ultimate determining variable that sets where we go. The market is trying to anticipate and front-run their decisions because they believe in that they will pivot at some time this year. If the Fed doesn't, it will be a huge rug pull for all the buyers right now. I think towards summer we will have a better decision of where we are likely to go, which is why since last year, I have been saying I don't want to buy stocks and make long-term investments until summer. I don't mind buying in late, because buying in late is smarter than buying in early before a rug pull. It's okay if you don't catch the perfect market bottom, so long as you know that you caught the dip and from there on out it's all upwards gain, even if slow at first. I hope this video was informative and clear to you all. I will make another one later next week. Until then, I hope you have a fantastic rest of your day and to the moon.